Welcome to the InterMarket Analysis video update. This is a weekly video where we look outside of just the S&P 500 to see what's the current valuation look like? What does growth versus value look like? What are other markets looking like? And then we tie that into the S&P 500 by doing some comparisons, just in case we can get some clues as to what's happening in the market itself. This is being prepared for Monday, November 18th. Before I get into that, there's a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. There's a link that will take you to the website as well as to a video that you can learn more about the program. Here's an email address if you want to contact me and talk more about this. Also, here's the intermarket analysis video. I do this every week, but the main foundation of my analysis is the daily video. And I know they're longer and I have a lot of charts. That's all by design. That's all to give us insight as to what's actually happening. So feel free to check those out. They are freely available on YouTube and Rumble. But if you're a member in the program, you get access to all these videos as soon as they're available, where I delay posting them on the different websites like YouTube and Rumble before they actually turn public. All right, first let's go in and look at S&P 500 valuation. Even with the pullback that we've seen, and we fell over 2% this past week, we're still looking expensive on a historical basis. We have the PE ratio of 10, 15, and 20, and we're well above the red dash line, which is the PE ratio of 20, a price to earnings ratio here. And I break it out down here, also showing that we're at a very, very high level, but we've been at a high level for a long time now. This also compares what valuations were like when different events happened going back to 1980. And Robert Shiller developed a variation of the regular PE ratio where he smooths it out over a period of time with earnings. And sometimes you may hear that referred to as CAPE, CAPE, or PE 10. Well, when he does his calculation, we're coming in at 37.43. And you can see the historical chart of what the valuations were. To give it a little bit more context, we look at the median and the mean here, and we're from 16 to 17, and we're coming in at 37. So this is also suggesting we are overvalued. But we've been this way for years now. So we don't use this as a timing mechanism. We don't use this to really make decisions. We use this more for informational purposes. Then we look at forward PE ratios, and this is what the market keys off of here. And there's a number of different things on this chart put out by Edward Yardeni. The purple area here, pink, whatever color you want to call it, these are the Mega Cap 8. Sometimes they're the Magnificent 7, the Illustrious 11, whatever you want to do with them. And they're coming in at 30 right now. They're well above the 10, 15, 20 scale that we usually use. But folks are okay with that. This is NVIDIA, this is Google, this is Microsoft. These are the companies that people want to buy low and sell high, and they don't really care that even looking out into the future, the stocks are expensive. They're hoping to buy low and sell higher, or buy high and sell even higher, if you're into that approach there. The one that I focus on the most is the red line, which is the PE ratio looking forward for the S&P 500. Even with the decline that we've seen this past week, falling over 2%, we're still coming in at 21.7. So we're still above that 20 level. The mid caps and small caps coming up a little bit here, getting above that 15 level, which is fairly valued. The mid caps are at 16.4, the small caps are at 16.3, but they're not necessarily considered overvalued at this point. You have to look deeper under the surface to see, okay, are the earnings actually justifying the PE ratio of where they're at right now? And small caps have been very frustrating in 2024. They lurch to the upside and then give a lot of those gains back and then lurch again. It could be that that's what's happening right now. Even though they were up since the election, small caps gave back 4% of their gains this past week. Then this is put out by Real Investment Advice, and I did show this in one of the daily videos, but because it has to do with valuations, I wanted to include it here. And this is real S&P 500. That means it's taking inflation into account. Here's a historical chart going all the way back into the 1800s, and what the S&P was based on inflation. That's the black line. And then what is the valuation right now? Here's the blue line. Let's see, the black line. No, I got that confused. The blue line is the S&P 500. The black line is the Schiller PE ratio here. And this gives you a little bit more context. And you can see how valuations and the longer term price for the S&P, even on an inflation adjusted basis, they have a real tendency to move in the same direction. And that's kind of what we're seeing right now. Okay, then Bloomberg came out with a chart that also suggests that stocks are undeniably, so apparently if you deny that, you're not seeing reality here. But it says S&P 500 trades at nearly 60% premium to global stocks. Now, you could look at that a couple of different ways. Yeah, these stocks are overvalued when you compare them to stocks in the rest of the world, but you could also say, but US companies are better and they're better companies and they give better products. So it's no wonder that they're overvalued when compared to global stocks. It just depends on your own perspective. And then they have a breakout of the PE ratio right here, which is also getting quite high at this point. All right, then we look at growth versus value. I first start off by just looking at growth all by itself in an uptrend, even though it got smacked a little bit this past week. Value also took it a little bit on the chin this past week, but in an uptrend by itself. Where we get insight is when we do ratios between the two. I take growth and I divide it by value. And then I have a number of different charts with a number of different indexes and ETFs to see if we can reach a consensus about how is growth doing compared to value. You want growth to outperform when the market's really going up. If value is outperforming growth, like we saw in 2022, that's when the market runs into trouble. Well, looking at this, you can see where growth is outperforming value. Then an inverse of that same chart shows how value is underperforming growth. And we look at some ETFs, longer term, going back to 2004, also showing how growth is outperforming value, and inverse showing how value is underperforming growth. And we look at some indexes here, the same index that I looked at earlier, but now we're doing a ratio showing how growth is outperforming on this chart, and a little shorter term showing how value continues to underperform growth. And we look at some ETFs, a growth ETF versus a value ETF. We came down, but we're still at the high end of this rainbow currently. And then we do an inverse looking at value versus growth, how it's been improving lately, but it's still at the bottom end of this rainbow. And we look at another index showing how growth is outperforming value here. And we break it down and look at how small cap growth to value looking right now. It was showing a real improvement, but now has since dropped back, and we're still in a longer term downtrend. And pretty much that same thing with the mid caps, still in a downtrend, improving, but falling back right now. The one that I follow the most is S&P growth to value. It's still in an uptrend, even though it has seen some recent weakness here, but it's been holding up. Now, if this continues to fall, that's going to naturally turn things more negative. If we can turn and go back up, that will be more positive for the S&P. We want to keep an eye on inflation. And first, I look at a monthly chart here, the CRB index. These are commodities, and we continue to pretty much chop sideways. Then we do a ratio of inflation versus deflation. This is continuing to decline. And so that just shows more deflation, that inflation is not necessarily a problem, according to this chart. And here's a daily chart of the CRB index, which is in a downtrend right now and has been chopping sideways for the last number of weeks. We also look at the Baltic Dry Index, and as a general rule, when this is going up, that's inflationary. When this is going down, that's deflationary. We've been chopping sideways. We broke lower, but now we're starting to come back up. And there's a little bit of concern out there that the economic reports that are coming out right now are stronger than expected. This idea that magically the Fed was going to cut rates in December, the market's not really taking that for granted right now, because we're seeing economic reports that are strong currently. And that could throw this whole rate cut scenario into doubt. And so we're seeing a little bit of chopping around here. Now, with the change in administration, this is supposed to be able to promote economic growth, which you could also see an increase in inflation. And the market is going to try to anticipate that. And so we might see some of our inflation gauges start to go back up, which is what we're seeing a little bit here with this chart. Then these are the inflation expectations, where we're not really breaking out now, but we have been going up. Here's the whole COVID crash here where everything went down. And we've been going back up now, but we've been chopping more or less sideways after we were seeing a real steady increase here. And aluminum, we just watched this just to see what's going on here. And it is in an uptrend with aluminum. Corn is continuing to be in a downtrend. Wheat is also in a downtrend. We keep an eye on fertilizer, which has been dropping in price recently. Oil, we watch this for a couple of different reasons, but right now it's more geopolitical because if things really escalate between Iran and Israel, that could really bump up the price of oil. But really, it hasn't had much of an impact, at least yet. We look at a gold to oil ratio. Now, gold saw some real profit taking, and oil is just kind of sitting where it's at. So we're seeing this ratio coming down a little bit. But in the bigger picture, we're seeing how gold has been outperforming oil. And we look at a correlation between oil and, which is the red dashed line, and the 10-year yield, which is black. And they both have been declining lately, but you can see when we do this correlation here, when this is going down, that means they're having a tendency to go in excuse me, opposite directions. You're gonna have to excuse my voice. I'm dealing with a bit of a bug here, even worse than usual. And then keeping an eye on gas where it's in a downtrend. Heating oil, which is also in a downtrend. Natural gas kind of chopping around, but now is resumed into an uptrend. Diesel, which this is the spot price, so this is cash right now, and a couple of different kinds of diesel here. Overall, has been continuing to decline. Copper's been all over the place. You would think copper would be going up if we're looking at a stronger economy going forward, but then it's just been getting hit lately. It's actually starting to give us a bit of a downtrend here. The blue line is in danger of crossing below the red line. And we look at a copper to gold ratio where gold's been pulling back. Well, copper's been pulling back too. And so we haven't really seen much of a change in this ratio. And this is also longer term. And I plot the 10-year and 2-year yields here, where for quite a while we would see them not get that far apart, even though they're on different scales and generally go in the same direction. And we're seeing kind of the opposite thing over the last few years, where interest rates have been going up and kind of chopping around, but the copper to gold ratio has actually been going down. And we're just trying to figure this out week by week to see, okay, does copper going up would promote economic strength, but gold going up, I mean, that's gold. You usually use gold because of uncertainty or insanity or crazy things happening. And so the market is still trying to work itself out with that. And you see here is gold. It's still in an uptrend, but it's well off of the highs. And I just look at the ETF. I don't focus that much on the futures contract. Silver also pulling back after hitting all-time highs here. And we look at the closing value of gold and silver and see that there's a pretty strong correlation between the two. So they're going in the same direction at the same time. We look at a gold to silver ratio on top and then the US dollar index in the middle. And the relationship's getting stronger between what we see in the top chart and the middle chart. And this just shows some of the interaction between precious metals and currencies, as the dollar's been pretty strong lately. Here is the dollar. It's still in a downtrend, but we've been really shooting up, getting into the 106 range here. The longer we stay above both of these lines, the more we might see a cross, a golden cross here with the trend. And then the euro's really been coming down as the dollar's been going up, and the Japanese yen has been coming down as the dollar's been going up. So then I break it out. Now we're still in an uptrend with the euro to the dollar. It's not going to turn into a downtrend until the blue line crosses below the red line. But you can see the real weakness here. And this is probably more advantageous if you want to take a trip to Europe now. They're not quite at par with each other, but it's a lot lower than it usually is. So you get a pretty good exchange rate right now. And the Japanese yen, which is still in an uptrend compared to the dollar after being in a longer term downtrend, but it's been pulling back now. And if we stay below these lines, we'll eventually see a death cross with the Japanese yen resuming the downtrend. British pound dropping below the 50 and 200-day moving averages, really dropping down here as well, but still in an uptrend when we use moving averages to measure this. And then we're not seeing much of a disconnect when we look at the weighted version of the S&P 500 and the equal weighted version. They're more or less moving together right now. And this is just showing that there's more of the broad market stocks or the rest of the stocks that make up the S&P 500 that are participating instead of it just being a few stocks, either up or down. We're not really seeing much of a change here when we do a ratio between the S&P and the equal weighted version here. When this is going down, that means the equal weight is underperforming. And notice how the S&P was going up. Everyone was saying it's just 7 stocks that are really driving the market. And that was true at that time. But we're seeing that changing now as this ratio has been going sideways for the last number of months. We are still seeing that stocks are outperforming commodities, and this is an inverse showing how commodities are underperforming stocks. The S&P 100, the biggest stocks that make up the S&P 500, are still outperforming, and we're still seeing a negative trend here when we compare the NASDAQ 100 to the S&P 500. Now, both of them are coming off of recent all-time highs, so they're both doing really well by themselves, but earlier on, when the market was really going up, it was the NASDAQ 100 leading. Now we're seeing where the NASDAQ 100 is not in a leadership role here. It's the rest of the stocks that are actually doing better. And the NASDAQ is also in a downtrend compared to the S&P, but showing some improvement here. We might see a golden cross with this ratio soon. And the NASDAQ 100 continues to underperform the rest of the NASDAQ, where for 2023, and really going up until the early part of 2024, the NASDAQ 100 was really leading things higher. This isn't necessarily negative. This just shows you what's leading the market. And it's actually the NASDAQ is outperforming the NASDAQ 100 currently and has been for a while. The mega caps, the really big companies, and comparing it to the equal weight ratio, we were seeing the mega caps really outperforming until we hit the summer. Now we're going sideways. And again, this is not necessarily negative. It's just showing that there are other stocks that are participating in the S&P 500 that weren't before. We keep an eye on small caps where we're still going down here. The red line is the ratio between small caps and the S&P. The blue line is the S&P itself, and we're seeing, they're going in opposite directions and have been for quite a while. And we look at the ratio here, where small caps really look like they were doing better, but now they're giving some of those gains back. Now, the S&P's been under pressure too, but the small caps gave back more, and that's why we're seeing this coming down. Longer term, small caps continue to underperform the S&P. The big software companies showing some strength here, pulling back recently, but still looking a lot stronger. The robotics and AI ETF coming back down to the top end of the rainbow, and still at the bottom end of the rainbow when we do a ratio between the robotics and AI ETF and the tech sector. Mega cap growth pulling back, but still looking really solid here. And the Dow Jones Composite Average, which is the Dow, the transports, and the utilities, pulling back, but still well above its 50-day moving average. And we look at small caps to tech, where we've been seeing a lot of choppiness as tech was under pressure earlier on. Then small caps look to be breaking out, but now they're pulling back. And so this ratio is just kind of chopping around sideways. And I show this in the daily video. This is kind of a more elaborate advanced decline line studies type of approach here. We're dropping below the moving average with the NYSE common stock, where they had been holding up throughout the summer months. We did pull back down at the end of October, only to go back above it. So just because we drop below this does not mean it's the end of the world, but we need to get back above this line to be even more positive. Where with the S&P, we're coming down to the moving average, and with the mid caps down to the moving average, and we're also starting to drop below the moving average with the small caps. The Wilshire 5000, after setting a recent all-time high, has been pulling back, but still above its 50-day moving average. The total U.S. stock ETF also pulling back, but coming off of a recent all-time high. The low volatility stocks, which folks get into when they're more defensive, when you look at it by itself, really looking pretty solid here. But when you compare it to the S&P, continuing to underperform here, we did see enough to see a golden cross here, but once that was generated, this ratio really started to go back down. And this is just showing a change in the overall climate of the market. And eventually it'll work its way out and decide if it wants to go up or down with this ratio. Transports, after recently finally setting a new all-time high, have been pulling back lately. And as this was going up, that means the Dow is outperforming the transports. When this is going down, that means the transports are outperforming, and now they both have been under pressure lately. And we do another ratio between the transports and the S&P. When this is going down, the transports were underperforming. But we're seeing some improvement here. If you go back into the summer months where we've been chopping more or less sideways and then starting to go back up, that could also suggest that the transportation stocks may see some favor going forward. And we look at the relationship between the S&P and the transports. Still pretty strong here. The correlation is way up pretty high. Then this is traditional Dow theory, where the Dow's just coming off of a recent all-time high. The transport's a recent all-time high. So that's a confirmation. Now, I also include utilities, which may not be part of traditional Dow theory, but I include it here, where they were stronger earlier on, but since that time have pulled back and are now going sideways. But then we look at this in a little different way. Instead of using the Dow, we use the S&P 500, which has been under pressure after setting an all-time high. And instead of using the transports, we use the NASDAQ, which has been setting an all-time high and then pulling back lately. We break that down even a little more with the equal weight version of the S&P, showing a little bit of weakness after an all-time high. And then it was confirmed by the equal weight version of the QQQs, which is the ETF for the NASDAQ 100. This is more or less confirming what we're seeing with each other. And the FANG index coming off of a recent all-time high, but then pulling back. And this is what we're seeing as far as trend lines. We're not able to get above this shorter term trend line. We went above that, but closed below it, and we now have been falling back. This longer term trend line, we're wondering if this is going to provide support. Now, it didn't. This is the big downward move we saw in August, and then a bit of a decline after that. But we were able to get back above this line here. So we'll be watching this to see if this support holds, because it has a few times after the mess that we saw last summer. And we'll see if we're able to bounce up off of that. If we do start to go up, is this shorter term trend line going to continue to provide overhead resistance? ARC, which is still, it's actually in an uptrend right now. And because I understand ARC owns a lot of Tesla, and that's been doing a lot better lately. And so that's helping this ETF perform better. And the all world ETF, if you take out US stocks, they're coming all the way down to their 200-day moving average. When you compare it on a ratio basis with US stocks against world stocks, US stocks are really still continuing to outperform. And then here's a longer term chart too of the S&P to global stocks, showing how US stocks are continuing to outperform, and the momentum oscillator that we use here is also going up. This is the price of bonds, the 7 to 10-year bond ETF, which has been under pressure lately as interest rates have been going back up. You can see down here at the bottom, the MACD is pretty much flat, but we're still below 50 with the RSI. Now, if this goes up, that means interest rates are probably going down. There's not a pure relationship between this ETF and interest rates, but it's close enough to give us an idea what's happening. This is the total bond ETF, which is still in a longer term uptrend, but has been pulling back, not quite down to its 200-day moving average. Really choppy here with the Pring World Bond Index, where we're still in an uptrend, but seeing some weakness here. And this is a monthly chart of a stock to bond ratio. When this is going up, that means longer term stocks are outperforming bonds based on price. This confirms that too. This is a daily chart showing how bonds are underperforming stocks. High yield bonds, we know them as junk bonds, just coming off of recent all-time highs, coming down to its 50-day moving average. And this has a tendency to follow what the S&P 500 is doing too. Investment grade bonds, more conservative, seeing some pullback as interest rates have been going back up, but not quite down to their 200-day moving average. Corporate bonds also still in an uptrend, but seeing some recent weakness here. And then these are not really telling us anything. This is some Fibonacci retracement levels with the 10-year yield here. This is longer term, how we're possibly shifting into a higher interest rate environment, which could promote interest rates going back up, but also some inflation concerns as well. And then here's another Fib retracement chart with the 30-year yield, but we're not close to any of those lines. Junk bonds continue to do quite well, still dealing with their 50-day moving average. And when we compare junk bonds with more conservative bonds, junk bonds are much more preferred currently. And we look at the daily yield chart here, where they had been really coming down with yields, and now we've been going back up. And here's a weekly chart internationally with US, UK rates and German rates being the highest, and then Japanese rates here in red. The correlation between stocks and bonds pretty much neutral right now. And then we look at the S&P versus the 10-year yield. And going back to the beginning of 2024, that's when we saw a golden cross here. And this is just showing that stocks are outperforming the 10-year yield. But lately, this has been pulling back as stocks have been under pressure and interest rates have been going back up. We look at the volatility of bonds as measured by the MOVE index, which is really dropping off because we were getting very high readings there. And then up until the election, we were getting very high readings with the VIX, which measures the volatility of stocks. That's dropped off. But with the declines that we saw that going back up here. And now this just measures volatility, not direction, but there's a pretty high correlation between the volatility that we're seeing in the bond market and the stock market. And then we do some ratios of the S&P 500 to short-term bonds, 1 to 3 years, coming down, but still at the top end of the rainbow. S&P 1500 compared to short-term bonds, coming down, but still above the rainbow. Broad market measure with 3 to 7 year bonds coming down, but still above the rainbow. The tech sector to 3 to 7 year bonds coming back down to the top end of the rainbow. And then riskier bonds, junk bonds with more conservative bonds like government bonds, showing how folks are willing to assume more risk to get a better yield. They're not seeing the junk bonds as being riskier right now. And then this just shows how bonds are underperforming stocks, even though it's been bouncing back up lately. And here's a monthly chart of the long-term bond ETF, 30-year, where it's been coming down in price after it had been crossing above the moving average. And then we look at a ratio between bonds and commodities, and this has gone on now since the end of 2022, where the price of bonds are actually outperforming commodities with the ratio. Then I break it out and look at the different sectors, the 11 sectors that make up the S&P, where materials are in an uptrend, but they're falling below their 50-day moving average, but they're still above their 200-day moving average. And after going sideways for a while, they're back to underperforming the S&P on a ratio basis. Communication, a stronger area, but seeing some recent weakness, but still looking pretty good when we look at the ratio of communication to the S&P. And energy, which had been kind of chopping around and seeing some weakness, is now starting to show some strength, but it's still in a longer term downtrend, even though it's improving when we look at the ratio with the S&P. The financials, one of the stronger areas, just coming off of recent all-time highs and actually outperforming the S&P. This is probably the strongest area currently. Industrials, still above their 50-day moving average, but seeing some recent weakness and kind of going sideways, but in an uptrend when we compare it on a ratio basis with the S&P. The tech sector seeing a pullback, but still above their 50-day moving average and pretty much going sideways, but in a downtrend when we look at a ratio of the S&P. Staples, toilet paper, toothpaste, seeing a little bit of weakness here, dropping under their 50-day moving average, and just seeing a death cross here with this ratio as the staples are starting to underperform the S&P. Real estate, which is really going up when interest rates were going down, well, now they're under pressure as interest rates have been going back up. So we're still in an uptrend here, but not really seeing a lot of follow-through strength with the ratio. Utilities were really strong, fell back underneath their 50-day moving average, and now coming back up to that 50-day moving average. And in an uptrend, when we do a ratio with the S&P, but some weakness, could be seeing some signs of improvement here. And then we do a ratio between the S&P and utilities, getting really choppy right now. When this is going up, the S&P is outperforming. When this is going down, that means utilities are outperforming. And healthcare. Now, a lot of this came in Thursday and Friday session because there's, I guess it's been announced that RFK Jr. is going to oversee, be part of the cabinet, and the healthcare sector didn't really take that all that well. Not because they don't necessarily agree or disagree with what may happen, but that there's going to be change. The status quo is going to be, shaken up. And so that puts some pressure on the stocks or on the sector itself. And so healthcare continues to really underperform the S&P. Discretionary still looking pretty good, one of the stronger areas recently all by itself, and showing an improvement with a recent golden cross here when we look at the ratio with the S&P. Semiconductors, not looking all that good here. Actually getting ready to see a death cross. That could be more negative. And we look at the energy sector to tech. Now, energy's been bouncing back lately, but longer term, it's still underperforming the tech sector. Growth areas are outperforming bonds, even with the recent weakness that we're seeing. And the tech sector to the 10-year yield coming down to the 200-day moving average here. We'll have to see if this ratio can hold up. Here's an inverse where we see the 10-year actually coming back up to the 200-day moving average with this ratio. Discretionary to staples, this is positive. And when the market is going up, we want discretionary to be outperforming staples, and we want staples to be underperforming discretionary. And gold to the S&P, where gold has been seeing some profit taking. Even though the S&P has been under pressure, this ratio has really come down. And we're seeing this coming down as well because the dollar's been seeing some strength as gold has been seeing some weakness. And the NYSE composite, after setting a recent all-time high, is still holding up, though, above its 50-day moving average. This is what I use as another barometer of the economy. The high leverage loans, these are very risky loans, and they're not falling apart. They're not even coming back down to their 50-day moving average, at least yet. International stocks coming down to their moving average, but still in an uptrend. Emerging markets falling back to their 200-day moving average, but still in an uptrend. The Japanese Nikkei, a little bit below its high set back in 1989, but still not really falling apart. And the micro caps falling back a little bit, but still in an uptrend here. And I was watching this a little closer. This is the correlation or the ratio between the S&P and the home builders ETF, where it was really starting to come down, but now it's starting to go back up. So I still look at this chart every day, but I'm not as concerned as I was since we're going back up now. Bitcoin coming off of an all-time high. And so be aware the scammers are out there. I get hit by this stuff too. The Skype groups, the Facebook groups, the you name it, comments on videos that I post about some Mary Smith that is a genius with Bitcoin. It's all scams, folks. I don't even pay attention to any of that. And Bitcoin is now back in an uptrend. And the market seems to like this. It's not, Trump says we'll have to see what actually happens, but he's going to do away with the central currency that the Fed was messing with, and he just kind of wants to leave Bitcoin alone to do its own thing. And that's capitalism. And the market and Bitcoin's been really reacting to that positively. And then we're still in a downtrend longer term when we look at China and emerging markets. Europe is trying to bounce back up here, and a downtrend in Japan, and pretty much flat right now in the US. Intermarket analysis, where we're actually seeing stocks, they are under pressure, but they're actually outperforming gold year to date. And we have the dollar, oil, and then bonds continue to be negative based on price year to date. Keeping an eye on some correlations, we look at the correlation between the S&P and the dollar. They're actually going in the same basic direction right now. And S&P to oil, slight tendency to go in opposite directions. The S&P to the 10-year yield, slight tendency to go in the same direction. And the tech sector to the 10-year yield also coming back down more to neutral right now as the market has been shifting lately. And the S&P to the 2-year yield, pretty strong correlated relationship. They tend to be moving in the same direction at the same time. Then some long-term charts here. This is a monthly chart of the NYSE composite, just coming off of a recent all-time high, and the momentum longer term is still positive. This is a daily chart where we're pulling back right now, but still looking solid when you look at the bigger picture. The S&P monthly chart here, still in an uptrend, but we're rolling over a bit here with the PPO, the momentum oscillator. A daily chart here with the S&P looking pretty solid above its moving average. And then we look at another ratio between the S&P and commodities, showing how stocks are outperforming. And then another look at the S&P to a global index, showing how U.S. stocks are outperforming. Still pretty much flat now with the KST momentum oscillator. Then at the very end, I go through and list those things that are positive, and the list is pretty long right now. And my definition of positive is when the 50-day moving average is above the 200-day moving average, and we really haven't seen any changes yet. Both growth and value are in uptrends by themselves. Copper's in an uptrend, but getting close to a death cross there. The British pound and the euro, even though they've been pulling back, they're still in uptrends compared to the dollar. The Japanese yen pulling back, but still in an uptrend compared to the dollar as well. Gold and silver are still in uptrends. The big software companies, mega caps, the FANG index, ARC, and the low volatility stocks by themselves, staples by themselves, the Dow Jones Composite Average, all of the bonds based on price, even though they've been under pressure lately. The tech sector and semiconductors, but semiconductors could be switching over to a downtrend. So we want to watch that one. The high leverage loans, that's more of an economic barometer that is still looking really solid. The Dow, the NYSE Composite, and the Wilshire are in uptrends. The NASDAQ and NASDAQ 100. The mid caps, small caps, and micro caps still looking good longer term, but under some short term pressure. All stocks, emerging markets, and Bitcoin is setting a new all time high here. Then when the 50-day simple moving average goes below the 200-day simple moving average, that's when we're negative. Pretty short list. CRB index and the dollar, which could change, even though it's been seeing some strength, not enough yet to actually change the longer term trend. Thank you. I hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.